The record loss. Nobody is talking about. The US Treasury Department quietly published a report in December that should have triggered alarm bells across every trading floor from New York to Singapore. Buried within the dense tables of the Treasury International Capital data was a number that represents one of the most dramatic financial retreats in modern history. China's holdings of American government debt had fallen to $688.7 billion as of October 2025, a level not seen since the dark days of November 2008, when the global economy was teetering on the edge of complete collapse. To understand why this matters, you need to appreciate how far Beijing has fallen from its position as America's primary banker. Back in November 2013, China held $1.32 trillion in U.S. sovereign securities, making it the largest foreign creditor to Washington and a cornerstone of the global financial architecture. Chinese factories churned out consumer goods for American households. Those households paid in dollars, and those dollars flowed back across the Pacific to purchase the bonds that funded federal spending habits. Economists even coined a term for this symbiotic relationship, calling it chimerica, to describe how deeply the two economies had become intertwined through these capital flows. That relationship has now been severed with remarkable speed and apparent disregard for consequences. Beijing has liquidated approximately 48% of its peak holdings, dumping more than $630 billion worth of American IOUs onto global markets over the past 12 years. The pace of selling has accelerated dramatically in recent months, with October alone seeing a reduction of $11.8 billion, a velocity that suggests urgency has overtaken caution in the minds of Chinese policymakers. What makes this exodus particularly striking is the market environment in which it occurred. The period from 2022 through 2024 produced some of the worst returns for fixed income investors in nearly a century. When the Federal Reserve launched its aggressive campaign to crush inflation by raising interest rates, bond prices collapsed because yields and prices move in opposite directions. The iShares 20-plus year Treasury bond ETF, a popular vehicle for holding long-term government debt, lost more than 11% in 2024 alone, while the stock market rallied more than 20%. Anyone offloading sovereign securities during this window was not just exiting a position, but actively realizing painful losses. Professional money managers do not voluntarily sell assets at depressed prices unless they face one of two situations. Either they need cash immediately to meet obligations and have no choice but to accept whatever the market offers, or they have concluded that holding the asset poses risks that outweigh the certainty of taking a loss today. China clearly does not face a liquidity crisis that would force fire sale pricing on its American portfolio. Despite well-publicized struggles in its domestic property sector, the country continues to run substantial trade surpluses with the rest of the world and maintains foreign exchange reserves exceeding $3 trillion. Beijing could easily hold these securities to maturity and collect the promised interest payments if financial return were the primary consideration. The fact that Chinese officials have chosen to accept billions in realized losses rather than maintain their stake in American debt tells us something profound about how the government now views these assets. This is not portfolio rebalancing driven by investment committees seeking better returns elsewhere. This is a strategic decision made at the highest levels of Chinese leadership, reflecting a fundamental reassessment of whether U.S. government securities belong in China's national reserves at all. The question that demands an answer is straightforward but deeply unsettling for anyone holding similar assets. What does Beijing know or believe that makes burning billions preferable to staying invested in what was once considered the safest asset on the planet? When dollars become weapons, the answer to why Beijing would accept such punishing losses lies in an event that occurred thousands of miles from the trading floors where these bonds change hands. In February 2022, Russian tanks rolled across the Ukrainian border, and the Western response that followed fundamentally altered how every major government on Earth thinks about storing national wealth in foreign custody. Within days of the invasion, the United States and its European allies executed a financial strike that caught even seasoned observers off guard with its speed and coordination. Approximately $300 billion in Russian central bank reserves Wealth that Moscow had accumulated over decades through oil and gas exports became inaccessible overnight across accounts in New York, London, Frankfurt, and other Western financial centers. The Russian government had believed these reserves were untouchable, stored in the safest institutions on the planet precisely because they needed to be available during a crisis. Instead, those funds became hostages, locked away through coordinated legal orders that transformed sovereign savings into stranded capital. The bulk of these immobilized assets, roughly $200 billion, now sit at Euroclear, the Belgian clearinghouse that serves as plumbing for international securities markets. Russia cannot touch this money, and the interest it generates, approximately $4 billion in 2024 alone, has been redirected to fund Ukrainian defense efforts. Moscow's emergency reserves are now financing weapons used against Russian soldiers on the battlefield, a humiliation that Beijing's strategists have studied with intense focus. Chinese officials watched this financial warfare unfold and conducted extensive internal assessments of their own exposure to similar treatment. The conclusions were apparently alarming enough to accelerate the selling we now observe in the data. Every dollar that China holds in American custody exists at the pleasure of the U.S. government, and that permission can be revoked whenever Washington decides that Beijing has crossed some geopolitical red line. The scenarios that could produce such a response are not difficult to identify, ranging from military action in the Taiwan Strait to escalation over disputed islands in the South China Sea, to aggressive economic measures against American allies in the region. Any of these flashpoints could cross whatever threshold Washington establishes for deploying its financial arsenal, and Chinese policymakers have no way of knowing exactly where that line sits until they have already stumbled across it. From Beijing's perspective, the $688 billion still held in American hands represents a vulnerability rather than an asset. National savings that could be converted into a forced donation the instant relations deteriorate beyond repair. Chinese leadership appears to have concluded that accepting a 15 or 20% loss through selling into weak markets is vastly preferable to watching their entire position evaporate under a sanctions regime designed to cripple their economy during a confrontation. The velocity of recent sales suggests that Beijing may be operating against some internal timeline that outside observers can only guess at. Central banks typically disguise large selling programs to avoid moving markets against themselves, spreading transactions across months or years to minimize price impact and maximize proceeds. The fact that China shed nearly $12 billion in a single month indicates that speed has become more important than price, with policymakers focused on extracting capital before some anticipated event rather than optimizing their returns. What that event might be, and when Chinese planners believe it could arrive, remains the most consequential unanswered question in global finance today. Who catches a falling knife? When the second largest foreign holder of American government debt begins dumping hundreds of billions onto the open market, basic economics suggests that prices should crater. Supply flooding into any market while demand evaporates typically produces a collapse in valuations, and in the bond world, falling prices translate directly into rising yields. If pure market forces were operating without interference, China's exodus should have sent 10-year Treasury yields soaring to levels that would make mortgage payments unaffordable for millions of American families, and push the federal government's interest expenses into genuinely catastrophic territory. That nightmare scenario has not materialized, at least not yet. Yields have climbed from their historic lows, certainly, but the Treasury market continues to function without the kind of violent dislocations that characterized previous crises. The explanation for this relative stability lies not in organic demand from investors seeking attractive returns, but in a coordinated effort by American allies who appear to be catching the falling knife that Beijing is throwing. Examining the Treasury Department data reveals a striking pattern beneath the headline numbers. While China's position has collapsed towards $688 billion, the United Kingdom has emerged as an increasingly aggressive buyer, with holdings surging to approximately $878 billion as of October 2025. This figure placed the British ahead of China for the first time since the year 2000, a remarkable shift that raises immediate questions about where this money is actually coming from. The economy across the Atlantic is roughly 1/6 the size of China's, and unlike Beijing, the financial center of London does not run massive trade surpluses that generate excess dollars requiring a home. The country actually operates a persistent trade deficit, importing more than it exports and consuming more than it produces. The notion that Westminster has suddenly discovered nearly $900 billion in spare capital to invest in American government securities strains credulity beyond the breaking point. The more plausible explanation involves London's role as a global financial hub, where money flows through sophisticated intermediary structures that obscure ultimate ownership. Much of what appears as holdings in Treasury data likely represents custody arrangements for sovereign wealth funds, central banks, and institutional investors from around the world who prefer not to appear directly in American records. The city is functioning as a way station, its financial infrastructure soaking up flows that might otherwise overwhelm markets or attract unwanted attention. Belgium presents an even more revealing case study in this shell game. Holdings registered there hover somewhere between $400 and $470 billion, depending on the reporting period, a figure that would represent an absurd concentration of national wealth for a small European economy. The explanation, of course, is that Belgium hosts Euroclear, one of the largest securities depositories on the planet, and much of what registers as purchases actually represents transactions processed through this clearinghouse on behalf of undisclosed clients seeking anonymity. The simultaneous surge in holdings from these two locations, occurring precisely as China sells, cannot be coincidental. This pattern suggests a coordinated effort among Western allies to take on the supply that Beijing is releasing, preventing a disorderly market collapse that would spike borrowing costs across the American economy. Washington appears to be calling in favors from its alliance network, effectively asking partners to strain their own balance sheets in service of maintaining stability in the global reserve currency system. This arrangement carries an obvious fragility that China almost certainly recognizes and may be actively exploiting. The allies stepping in do not possess the same capacity that Beijing accumulated through decades of genuine trade surpluses. They are stretching, borrowing, and leveraging to fill a gap that keeps growing as American deficits now exceed $1.8 trillion annually, while total federal debt has surpassed $38 trillion. The cushion these government-backed buyers provide could disappear rapidly if their own economies stumble, or if domestic pressures force them to prioritize their own needs over Washington's borrowing requirements. The golden pivot. If China is selling American debt, the obvious question becomes what Beijing is doing with the proceeds. Hundreds of billions of dollars do not simply vanish into thin air, and a government as strategically calculating as China does not liquidate core reserve assets without a plan for redeployment. The answer has been gleaming in plain sight for anyone paying attention to central bank purchasing data over the past 2 years. The People's Bank of China has been accumulating gold with a persistence that borders on obsession. Official figures show 13 consecutive months of purchases running through November 2025, bringing total reported holdings to 74.12 million ounces. This buying spree pushed gold's share of Chinese foreign reserves to approximately 8.3%. Still modest compared to Western central banks, but representing a dramatic acceleration from historical norms. Many analysts suspect the true accumulation runs considerably higher, with purchases routed through state-controlled commercial banks and sovereign wealth vehicles that escape official reporting requirements. The timing of this pivot reveals the strategic calculus with uncomfortable clarity. Gold purchases accelerated sharply after Western nations demonstrated their willingness to freeze Russian assets, transforming what had been gradual portfolio diversification into an urgent priority. Every ounce of gold sitting in vaults on Chinese soil represents wealth that cannot be immobilized by foreign governments, seized through sanctions, or devalued through money printing by a rival central bank. This calculation extends beyond mere protection against seizure. The leadership in Zhongnanhai appears to be positioning for a potential restructuring of the global monetary system, one where the dollar, as dominance erodes and hard assets regain their historical role as the ultimate foundation of national wealth. China has watched the United States accumulate $38 trillion in debt while running annual deficits approaching $2 trillion. And policymakers seem to have concluded that this trajectory cannot continue indefinitely without consequences for the currency that denominates all that borrowing. The gold strategy also provides insurance against a scenario that keeps planners in the Communist Party awake at night. If tensions over Taiwan or other flashpoints escalate into open confrontation, China needs assets that remain accessible regardless of what Washington decides to do with the global financial infrastructure it controls. American Treasury bonds become worthless the moment the United States declares them frozen, but gold bars and Shanghai vaults retain their value regardless of geopolitical circumstances. Central banks worldwide have noticed this pivot and drawn similar conclusions. Global gold purchases by monetary authorities have shattered records in consecutive years, with institutions from Poland to Singapore to Turkey all racing to reduce dollar exposure while increasing allocations to the metal that has functioned. As humanity's preferred store of value since ancient civilizations first recognized its worth. China may be leading this movement, but it is far from alone in questioning whether American debt still deserves its privileged position in global portfolios. The physical pivot. Gold represents only the most visible component of China's diversification away from American financial assets. Beneath the headlines about precious metal purchases, Beijing has been executing a far broader strategy of converting dollar-denominated paper wealth into physical commodities that cannot be frozen, sanctioned, or deleted from a ledger by hostile foreign powers. The scale of this accumulation reveals a nation preparing for a future where access to international markets can no longer be taken for granted. Oil reserves have swelled to levels that dwarf anything seen in peacetime history. Estimates place the petroleum buffer somewhere between 1.2 and 1.5 billion barrels, with satellite imagery of tank farms and underground caverns, suggesting the true figure may run even higher. Throughout 2025, imports ran approximately 900,000 barrels per day beyond what refineries actually consumed, systematically filling every available storage facility while prices remained manageable. This buildup provides a cushion measured in months rather than weeks, enough to sustain the economy through an extended period of supply disruption should maritime shipping lanes become contested or closed entirely. The copper story proves equally revealing about strategic priorities. The country imported roughly 28 million tons of the metal in 2024, despite a domestic property sector that had collapsed into its worst crisis in decades. Under normal economic logic, a construction industry in freefall should produce cratering demand for the material that wires buildings and conducts electricity through modern infrastructure. Instead, buyers continued absorbing massive quantities, building inventories that serve no immediate commercial purpose but position the nation advantageously for any future supply crunch or trade restriction. Agricultural commodities complete the picture of a government thinking in terms of siege preparation rather than normal economic management. Grain reserves have grown so vast they distort world markets, with estimates suggesting roughly 60 to 70% of the planet's corn holdings and approximately half of all wheat inventories now sit in warehouses across the mainland. These stores far exceed any reasonable buffer against crop failures or supply chain disruptions, pointing instead toward a leadership that views food security through the lens of potential great power conflict. The common thread connecting oil terminals, copper warehouses, and grain silos is their immunity to the financial weapons that proved so effective against Russia. Sanctions can freeze bank accounts and immobilize securities held in Western institutions, but they cannot make physical barrels disappear from storage tanks on sovereign territory. The hundreds of billions flowing out of Treasury bonds have been transformed into tangible resources that will retain their utility regardless of what happens in the diplomatic or military relationship between Washington and Beijing. This conversion carries implications that extend beyond strategic planning in Zhongnanhai. Every barrel stored in Shandong or ton of copper warehoused in Guangdong represents demand that supported commodity prices even as traditional economic indicators suggested weakness. When the accumulation phase eventually ends, either because storage capacity is exhausted or because the anticipated crisis actually arrives, markets will lose a buyer that has been providing a floor under prices for years. The investor's dilemma. Everything described in the preceding chapters creates a genuinely difficult situation for anyone managing a portfolio with meaningful exposure to American fixed income. The largest foreign holder of Treasury securities has spent years systematically reducing that position while simultaneously building reserves of assets specifically chosen for their immunity to Western financial leverage. This is not the behavior of a nation that expects smooth sailing ahead for dollar-denominated investments. The conventional wisdom that has guided institutional allocation for decades holds that government bonds represent the safest asset class available, the place you flee toward when everything else falls apart. That assumption rests on foundations that China's actions suggest may be eroding. When a creditor nation with nearly $700 billion still at stake begins prioritizing the exit over the yield, prudent observers must ask what Beijing sees that the consensus might be missing. Bond mathematics offer little comfort to those hoping the selling pressure will soon exhaust itself. The Federal Reserve has been reducing its own holdings through quantitative tightening, removing another major buyer from the market precisely when foreign demand is softening. Meanwhile, the federal government continues issuing new debt at a pace that would have seemed unimaginable a generation ago, with annual deficits running near $2 trillion and total obligations now exceeding $38 trillion. The arithmetic of supply overwhelming demand typically resolves in only one direction, and that direction is not favorable for existing bondholders. Interest rate risk compounds the challenge facing fixed income investors. The brutal period from 2022 through 2024 demonstrated just how much damage rising rates can inflict on bond portfolios, with long-duration funds losing more than a third of their value in some cases. The iShares 20-plus year Treasury ETF declined roughly 11% in 2024 alone, extending a drawdown that ranks among the worst in modern history for U.S. debt markets. Anyone who believed government bonds provided reliable ballast for a diversified portfolio received an expensive education in duration risk. The difficult truth is that no perfect hedge exists against the scenario China appears to be positioning for. Gold offers protection against dollar debasement, but pays no yield and can experience violent corrections of its own. Commodities provide inflation protection but carry storage costs and contango losses that erode returns over time. Foreign sovereign debt diversifies currency exposure but introduces its own political and credit risks. Cash preserves optionality but guarantees purchasing power erosion in an inflationary environment. What remains clear is that the passive assumption of U.S. financial dominance no longer suffices as an investment thesis. The nation, holding the second largest position in Treasury securities, has declared through its actions that this assumption deserves scrutiny, and individual investors ignore that signal at their own considerable peril. Warning signs and exit doors. The question every investor must answer is not whether China's Treasury exodus matters, but how to recognize when the slow bleed accelerates into something more urgent. Several indicators deserve close monitoring in the months ahead. Watch the monthly Treasury International Capital reports for any acceleration in selling beyond the current pace. A sudden drop of $30 billion or more in a single month would signal that Beijing has shifted from strategic repositioning to emergency liquidation. Monitor the spread between Treasury yields and those of comparable sovereign debt from Germany or Japan, as widening gaps suggest foreign buyers are demanding compensation for risks they previously ignored. Gold prices above $3,000 per ounce, sustained for multiple months, would confirm that central banks worldwide share Beijing's concerns about dollar-denominated reserves. Finally, pay attention to any Chinese moves to price oil imports in yuan rather than dollars, a shift that would strike directly at the foundation of American financial hegemony. The fortress is being built in plain sight for those willing to observe the construction.